interest rates, inflation, where inflation becomes very, very risky is like in 2008 when you see big changes happening in short periods of time. That's where it becomes very risky. So I think that is what needs to be mitigated. Not the amount of rates hikes. I think it's more about the how fast are you going every single time. Welcome, everybody. Thank you for tuning in on the Investor Market Optics with Brian and Omar. Brian is a strategist, an investor, a coach, and somebody who has a wealth of knowledge and somebody who loves to look at market stats and explain them and provide the perspective. Myself, I'm a broker of record in a real estate company that I own, and I am somebody who's in the trenches looking at the first changes and also guiding people to making good decisions in real estate. And in today's episode, we're going to talk about the massive reduction in inventory versus this, slight increase in interest rates and what's going to win between these two. So I wanted to, check up on you, Brian. How are you feeling? Are you ready for today's session?
I sure am. And this one's a fascinating discussion for me, first of all, because I know you and I have some slightly different opinions about some of the details in this. But also this one, like, what's everyone talking about? Interest rates, interest rates, interest rates. You can't open up I was going to say open up a newspaper. Does anyone open up a newspaper anymore? You can't go online without hearing all about what's going on in interest rates. And yet the discussion about the massive reduction in inventory, unless you know a professional like Omar, you're probably not even hearing about this or seeing the numbers around it. So this is a fascinating one, I think, and let's dive into it. I got my boxing gloves on. I'm ready to go toe-to-toe with you, Omar.
That's awesome, man. I'm going to set you right in this episode, my friend. So this is going to go down in the history, my friend.
Ding, ding, round one.
So, guys, if you have not watched the last 3 episodes, we talked about FOMO. We discussed how, people getting gifts from their parents has played a crucial role in some of the changes that are happening in the real estate market. We also talked about a deep dive on the stats and looking at specific cities and specific property types and understanding what's going on. The reemergence of investors was the 3rd episode that we did this month. And if you want to listen to any of these episodes, again, you can just contact me and I can send you these videos. And like Brian said, ding, ding, let's get started. So over here, we're going to look at the global interest rate changes, and you can see the red sections talk about cuts, the blue ones are about hikes, and yellow is no changes. This is a little old, and we've already started to see some changes in Canada, but they haven't been massive changes.
Well, it's been announcements. They've still kept, there was no rate hike on the last announcement, but there's all this hinting of what's going to be happening in 2022, right? So this is an indication of, for the end of this year, 2022, supposedly, which you and I are going to talk about a bit, is going to be potentially quite a bit different. This map will likely see a lot more blue in 2022. At least that's what everyone's telling us.
100%. I know that banks have already started to increase their interest rates slightly, and that's in anticipation to what's going to happen, and to be competitive. They see the opportunity there, but like you said, I do think as well that we're going to see a lot more blue on this map over here in the next maybe 6 to 12 months. So if we look over here, the central bank keeps its target of overnight rate at the 0.25. It's been in line with the forecasts. The borrowing costs are expected, as of what they say in the news, is they're expecting to keep it until the middle of 2022, with this real estate market being a record real estate year. And a lot of upward pressure on price. The market, the banks are considering, increasing the interest rates and trying to mitigate inflation. What are your thoughts on that, Brian?
Well, I mean, right now, and I know you and I have talked about this, and you're leaning a little bit more towards what we're hearing in the media, that there could be a number of different hikes,
Yep.
6, 8 hikes in 2022. Personally, I don't see it happening.
Right.
I think it's impossible. I think all the things we've been talking about in the last few videos, to me, say that our market can't bear that many rate increases. I mean, we talked about in one of the earlier videos all these parents that are borrowing against the equity in their homes. So that means they're adding HELOCs or mortgages, or they're taking out of their retirement funds in order to lend their. So that means that we're having the older generation now add more debt into their lives, and it's house debt. So how on earth is the Bank of Canada going to be able to raise rates? The young people buying are not going to be able to pay higher mortgage, and the older generation, now all this debt that they've taken on, there's two huge segments of the population that are going to get hamstrung if the Bank of Canada raises rates too fast and raises it too much. I don't think our market can bear it.
100%. No, I think we both are in agreement that the raising of interest rates is a necessity,
It's
but
going to happen. There's going to be some raises. There's no
there
question
has
in
to
my
be
mind
there
that,
has to be raises.
from a safety standpoint, we have to see some, but not what they're predicting.
And the concern that I would have is if interest rates go up too quickly, if you have a large increase in interest rate, that I think is going to be more crippling to the industry than having multiple small ones where
Agreed.
you can buffer through these impacts, and the confidence of buyers and sellers is not going to be very highly affected. And I believe that the sooner the interest rates rise, the better for everybody. The longer they keep them, the more they're going to be forced to make larger changes. Instead, I would be much happier seeing, some happening sooner than later, small hikes, 3 or 4 or 5 over the year. This way, we can deal with inflation without creating a crippling effect on the market, because the real estate market is a big part of the economy. It is a huge part of the economy.
Huge part.
And
Huge part.
And like you said, we can't afford to go wrong here. And interest rates, inflation, where inflation becomes very, very risky is like in 2008, when you see big changes happening in short periods of time. That's where it becomes very risky. So I think that is what needs to be mitigated. Not the amount of rates hikes. I think it's more about how fast are you going every single time.
I agree, although I don't agree with you that it needs to happen sooner rather than later. I understand what you're saying, and I feel the same way. I don't want to see big rate jumps, but I think leaving it in, originally they were talking about the second half of 2022 they would start to raise, and now they're saying that might get bumped up. I don't think that's such a great idea, and the reason why I don't think that is because of exactly what you're talking about. We need things to happen slowly, but what's the point? Like, COVID is not over. I don't care what anybody is saying at this point. If all the lockdown protocols are gone by March, no masks, all that, I'll eat my hat here live on video. I don't think it's going to happen. I mean, when has anything else that they've predicted to do with COVID happened on the time frame that they've predicted it in? So if they start raising rates too early, and then we get any kind of COVID thing or another economic problem, or China declares war on Taiwan, and all of a sudden the economy starts to dip down again, well, they're just going to have to lower rates again, right? So what's the point of raising them just to have to rebound, which happened a couple of years ago? If you remember, the US decided to not raise rates, Canada did, and within a short period of time, they were just down again. So what's the point of doing that? All that does is screw up those people that were trying to buy at that point. And I'm a variable rate lover, so of course I'm not in a hurry for rates to start going up at any time soon. I sleep happily at night with my variable rate mortgage, and that's the way I'd like to keep it. Thank you very much.
Well, you know how it is. It's a very, very fine balance, and the longer things stay, the more you're faced
I
and
agree with you there. I agree with you
forced to
there.
make
They, yeah,
major changes. And it's not the increase in rates that's going to, I mean, the market, even until, we talked about this in the last video, it's October and the market's still going up,
yep,
right?
you're
So
right.
a little bit of calming that down is not a big deal, right? And if we can soften the market a little bit without creating massive difference, I think
Yes,
then we're helping ourselves in 6 months where we're
we
not
agree there.
forced to make major changes, right? It's a very fine balance. And
Yep.
I obviously I'm in the industry and my business will be affected when interest rates rise. But I also don't want to see, everything falling apart and people making, people are emotional beings, and as soon as they see something like this, they push the brakes straight away, and I don't think that's
Yep.
going to be. So
We
that's
agree
where I.
there. Absolutely.
And so the second part of this conversation is the supply conversation, the supply part of it. If we look at what's happened since September 2019, that's the supply story for you. We were hit with COVID. Supply went skyrocketed up. The condo apartments continued to be pretty high in September to January. The supply was very high. It was in the 3.5, 3%, the 3 months of inventory. I remember talking to people in the midst there and saying this is going to be absorbed very quickly. And that's exactly what happened. It went very low under the 1 and then went back up. And now we're settling somewhere around the 1.5, which is, I think, where it's supposed to be. You're supposed to see you're not going to see the supply of condos being lower than the supply of detached, just because of the vast amount of condos that we have in comparison to detached properties, which also, in comparison to the townhouses and the semis. I think the distribution is somewhat right, but we're seeing one constant for sure is we're seeing that they're all hovering at 1.5 and under, which kind of talks to how tight this market really is. And then if we look at the big picture and if we zoom out to 2010, look at what happens. Look at how clear this story is being depicted by this graph. Look at how the single detached and the apartments, they converge and then they start to go down. And that's a decade. That's a real trend. When you see something over a decade, you're really able to tell what's going on. And we're going through a problem here in Canada, or in Toronto, where we do not have enough new houses to satisfy the amount of demand that's coming into the country. And wait until immigration kicks in.
That's what I was just going to say. We were talking in the last video about immigration being double what it was before. Now, as a real estate investor and somebody who has suites, I mean, that makes me happy because number one, that means I'm going to have tenants, right? New people moving here are going to become my tenants, and then eventually they're going to become the people that buy the units from me, especially because condos are the area or the type that I typically focus on. So, and that's why I'm saying to people, if you can get more property right now, I don't think it's going to be a bad thing in the future.
100%,
Again, don't
100%.
rush out and buy the first thing that's for sale.
100%.
But these are all good. But so I'm curious, what do you think? If we see a raise in interest rates, what's that going to do to the supply numbers? Are we going to see all of a sudden buyers getting out, and now there's going to be a glut of supply because there's going to be all these units that people are looking to sell, and buyers will have gone? What do you think is going to happen if interest rates do start to rise,
Check
Omar?
out this chart. Check out this chart, Brian. Look at how low supply is. This is since 2012. Look at how low supply is. Look at how low we are in comparison to the 10-year average. We're almost half, right? So is the interest rates going up slightly? Are they going to, reduce demand? Is that going to increase months of inventory? Most likely. And I think that's not a bad thing. But I also think that supply is too damn low. It's too tight for there to be a catastrophic change in the industry, in the market. So
I agree.
I don't know. I can't predict. I don't have a crystal ball, obviously. But I think that we are in a good place with supply being so scarce to reduce some of the demand that's coming up in the next little while. And in the chart on the right side, we can see the dance between the monthly sales and the monthly new listings, the demand and supply. So you can see how close they are, and that tells you about how much tension there is. There's a lot of tension between demand and supply here. If we look at this chart, we're looking at the effect on prices because of the low supply, and we see that year over year, the detached market's been up 28.9%, the semi market
Wow.
20%, 11% for the condo market. Can you fathom a 28.9% at a 1.5 average? Right? Like, can you fathom what that number is in 1 year? It's insane.
Especially given that we were in the middle of a once in 100 years global pandemic. Like that's, like I said earlier, that's where I was so shocked and surprised about what happened. And clearly I do not have a crystal ball. No, it's crazy. And I agree with you. I 100% agree. Will we see maybe a little bit of a back to normal in terms of supply and demand? I hope so in some ways, right? Because that just makes life a little bit easier. But is it going to be catastrophic? Are we suddenly going to have a glut in supply? No, I don't think so. In fact, what I think is going to happen is in the short term, in the next 6 months, it's going to get even worse, because all these buyers are going to want to be rushing into the market before interest rates start to go up, right? Locking in with mortgages before that. So you're going to see supply go even lower. This 15, what was you were saying, one of the previous videos, in Halton, your property is going to sell in an average of 5 days. That'll probably go down to 1 day pretty soon in some of these areas where the agent is banging in the sign and somebody's got an offer ready to go, because people are going to flood. They love to behave on fear and headlines and all that, and then things are hopefully going to stabilize after rates start to go up. But I think we're still going to have a lot of supply versus demand issues in the near future, the 1 to 2 year range.
There's an uncertainty that will come with the next 6 months. We don't know how it's going to really look like. Nobody does. But I think if we go past that 6-month point, I think any stimulus that happens, including the increase in rates, it will affect the market for a shorter period of time, and then everything will start to subside, just like we've seen in much larger stimuluses. The market continues to go back, and then there's a reshuffling in market growth. And look at the chart on the right and tell me, where is that reshuffling going to go? Look at how big the gap is today between detached and townhouses. Look at how big the gap was in May 2020. Look at how big the gap is between condos and detached. I remember, in 2018, 2019, where condos and detached properties were so tight in the gap. Then there was such a tight gap, and I think that was maybe a reaction in the condo market where it went up a little too much, it overshot. But still, like, this is not normal. This is not the distribution that we've been privy to over the last 10 years. And I think that there is going to be some reshuffling there for sure. But the interesting part is looking at that detached curve, and you can see the tip of it still going pretty high up.
Yep.
Pretty high up.
Yes,
So
it is.
Really interesting to see what November and December are going to bring.
Exactly what you're talking about here, that gap between the blue line and the black line, the condos versus the detached homes, is precisely why I'm seeing a lot of investors reach out to me and ask me about the condo investing that I've been doing over the last 7 years. How do I start to get into this? Because if they've been used to doing the detached homes and that sort of thing, and now it's a completely different animal with condos, I'm getting a lot of people asking me about, hey, are you going to run that condo course that you do where you talk about pre-construction condos? And on a personal note, so I had 3 units that went into occupancy in Toronto at close to Yonge and Eglinton. And normally, I might be looking to sell those, to do some reshuffling, look at different investments, different markets. I am finding a way to keep, I'm definitely keeping 2 of them, because exactly what I look at this and I'm like, it only goes up from here, baby, right? So what a great time if either getting in that condo market, or if you have condos, if you've done the pre-con game, now you're getting close to closing, hang on to them for a couple more years. Find a way to make that flow. Again, it's got to fit in with your goals and what you're trying to accomplish. But I completely agree with you, and I'm excited about this. Just to give people an idea, the condo that I bought 5 years ago, the three of them in the same project, were around the $400,000 mark. I just got an offer of $685 for one of them, and the other two are around the same mark, around the $700,000 mark. And I believe those are going to be $1 million condos in another 5 years. Why would I not find a way to hold on to those, like we talked about in the last video, right? Don't wait to buy real estate. Buy real estate and wait. And again, this is the data that backs up what we're talking about here.
Absolutely, absolutely. And I guess the moral of the story in this video, for me at least, is that we can't rely fully on the market and what the market's going to present. It's uncertain, and we need to be running our strategy based on some certainties, based on things that we can control. Like, for instance, for me, right now, buying an investment property, I would buy into a fixed rate, because it's still a good rate. I'd run my numbers based on it. I'd build my plan based on it, and I'm secure and I'm set, and I'm not going to have any. It doesn't matter what the market does. It's I've got in. I know that I'm in for the long term, as we mentioned in the previous video. We are looking at a long-term investment, and my mortgage doesn't matter if it goes up by 10 points or 50 points or whatever it is. It's still going to be the same for me. So I think you need to always look at things and say, how can I make certainty out of uncertainty?
Yep, absolutely. You can keep your costs fixed. You're going to know what your cash flow is going to be. You can watch rents continue to ratchet up. You're going to be in a big spot. For me, I like to have that flexibility. I don't like the way the banks have these massive penalties if you do need to refinance or make some changes inside that mortgage term. I don't like that. I don't like being held at the mercy of the banks around that. If you know you're not going to be selling or refinancing in 5 years, absolutely get that in there. But I like that flexibility with a variable rate. I don't think mortgages are going to go up that dramatically. And I've got that built into my plan already. So I'm going to be able to account for it. It's funny, Omar, I was thinking, usually you and I are on the same page. I was ready for the heavyweight bout, going 12 rounds with you. Turned into more of a pillow fight this time around. You and I are still just so like-minded, and the way we approach things. So it wasn't a street fight after all.
Well, fundamentals are fundamentals, and we share the same fundamentals, right? With small opinions here and there, but we're still on the same page. But regardless, ting, ting, ting. Tell us, who do you think won in this round?
Well, I think it's still going to be the low supply. I think the massive reduction in inventory is going to have more of a dramatic effect than the slight increase in interest rates. I agree, it's going to happen. It needs to happen. It's going to create more of a balanced market. It's going to help with inflation, but I think the Bank of Canada is going to have to ratchet it up slowly, maybe some pauses in between if we do have some economic negativity. But yeah, it's going to, the inventory is still going to be the big headline in 2022 and maybe even in 2023. And by the way, you put the fun back in fundamentals, Omar.
Guys, this was a pleasure for me to be on, in this, challenging you, Brian, and exploring the two scenarios. I hope you guys found this to be valuable, and I hope that you've learned a few things and that you can include some of this stuff into your long-term strategy and investment. If you guys need any additional information or support or guidance, please feel free to reach out. And until the next one, I hope you guys have an amazing week.
See you next month.